Hi, I'm Joss Murphy, research analyst at Chelsea Financial Services. Today, I've been joined by Nick Martin, manager of the Polar Capital Global Insurance Fund. How are you, Nick?
I'm very well, Josh, and thanks so much for having me.
Well, great to have you on. Great to have you on. Nick, let's start with the current economic and investment environment. How do interest rates, inflation, and slow growth impact the sector?
Yeah, I think for my sector, so non-life, property, casualty insurance, one of the attractions has always been it's relatively disconnected with what's going on in the broader macro economy. And insurance itself is a product that is really is a must-have. I think over time. So even in more challenging economic times, the demand really stays there. And so when we do have a more grey clouds and stormy clouds gathering in the environment, the demand for the product remains robust. And I think, therefore, that gives the sector some defensive characteristics, which is quite helpful in those more challenging times. With inflation and interest rates, we're actually a beneficiary of that. So a lot of insurance premium gets priced off of things like company revenues, things like company payroll. So as inflation goes through the systems, premiums actually rise commensurately with that. So that's a boost to the top line of our companies. And then probably even more significantly with interest rates, now our companies take on underwriting risk. So what they don't like to do is double up that risk with exciting things within their investment portfolios. So they have very liquid balance sheets, lots of cash, 2 to 3 year bonds, because you need that liquidity there to pay claims that can happen at any time. Now, since the financial crisis, the sort of returns on those kind of assets have been sort of 1-2%, something like that. Today, it's more like 4 or 5%, arguably a little bit more. And that's really helped transform the earnings power of our companies from a sort of a low double-digit kind of a return on capital to one in the mid to high teens. And I think that provides a very exciting investment opportunity for investors who may be thinking a little bit harder about a more tough outlook in the coming months ahead.
No, certainly an interesting and an exciting time for insurance. Nick, looking more globally, we've had a summer of wildfires, flash flooding, and other catastrophe events, as they're called. Now, this part of the insurance sector intrigues me, but before we get on to the subject, I think a quick tutorial would help. Can you briefly explain what a reinsurer and what a primary insurer is?
Yeah, absolutely. So the primary insurer, what we're all used to dealing with every day. So that's when they're buying your home insurance or your car insurance or the corporate equivalents for when businesses buy insurance. So that's the company you're buying it directly off of. But I think it's always important to remember, how insurance works. It's the premiums of the many pay for the losses of the unfortunate few. So that you really need that to work for your insurance business model to be robust. The problem you have with something like catastrophes is that you get a lot of concentration of losses all at the same time. So you, as the primary insurer, want to try and manage that risk. And one of the ways to do that is to buy reinsurance. And reinsurance, and it comes in various different flavors. You can use that as a capital tool. So you're basically renting someone else's balance sheet as an insurer. But what we've been talking about a little bit here is really to manage that catastrophe risk. So when a bad thing happens, when you have a hurricane or an earthquake or any other kind of event, the reinsurance company is there to help you as the insurer pick up part of the bill. And I think what we've had in more recent times is the reinsurance industry picking up a disproportionate amount of that bill, as we've had the impacts of climate change leading to things like more wildfires, more flooding, more droughts. And that's really led to a big reset in the reinsurance market in terms of pricing going up this year, which has left a bigger part of that bill more with the primary insurance companies, which in turn is leading to many of those pricings having to go up. Because at the end of the day, the insurance cost that you're paying should be reflecting the risk that you're taking. So if there's more catastrophe events in the world from climate change or otherwise, we could expect insurance pricing to go up so that the underwriters themselves have a expectation to make a reasonable level of profit over time.
To set the scene a little more, you said in a recent update that you think this year will end up being the fourth consecutive year that a natural catastrophe losses will top $100 billion, and that it will be the second highest level of losses since 2011. Who bears the brunt of these losses, and how is that changing?
Yeah, I think we have seen over many years now a rising level of catastrophe losses. I mean, one distinction that's important to make is between the economic losses that happen as a result of those catastrophes, and also how much of that is picked up by the insurance companies itself. As a rough rule of thumb would be, when a major event happens, the insurance industry collectively, so that's the primary companies and the reinsurers, would pay about 30% of the bill, and therefore 70% is therefore left for others to pay, whether that be that those particular asset owners or governments or whatever, or that risk remains uninsured. And the sort of numbers that you're talking about with the $100 billion or so, that's the level of insured losses that we've been seeing in more recent years. I think a recent commentator has pointed to maybe $130 billion now is the sort of level of expected insured catastrophe losses, and that number continues to rise over time. So I think the important message really is the insurance companies are there to bear that volatility, and they play a very important role. So when bad things happen, and obviously climate change is the big driver of that, the insurance companies are there to help individuals and to help companies and to help society in general get back to where they were. And having insurance in place means that money can get to where it's needed very quickly, and therefore help economies and society get back on its feet after these sort of tragic events that we see happening all too frequently, sadly.
And finally, going back to the portfolio, I noticed about half is invested in medium and smaller sized companies, which I think is more than usual. Tell us about the opportunities you're finding here.
Yeah, so I think in terms of how the portfolio is structured, I mean, the focus has always been to have 30 to 35 companies who typically are more small to mid cap, and the definitions of what that means can vary. So for us, that's about sort of 10 to 15, maybe $20 billion market cap. So by no means, very tiny companies, but we're not really talking about the huge sort of insurance conglomerates, the sort of names that most people would recognize. For us, we focus on much more niche companies who are very specialist in what they do. And I think a big theme that we've seen over recent years is that risk is becoming ever more complex. So some of the risks that used to be underwritten by large insurers or mutuals in places like California and Florida, because of climate change and other reasons, that they've moved away from their wheelhouse. And where those risks are ending up is more in sort of specialty markets like Lloyd's of London and their equivalents around the world. And that is rapidly expanding the opportunity set for our specialist underwriters. And I don't see any way that's going to be changing in the year ahead. If anything, I think risk is going to become ever more complex. And we're living in an age of risk. We see it everywhere. Sadly, whether it's climate, whether it's pandemics, whether it's wars or deglobalization or whatever it is, risk seems to be rising in the world. And that's an opportunity for the insurance industry to help society manage that risk. And therefore, the long-term characteristics of this industry in terms of growth, we think is looking much brighter going forward than it necessarily has done in the past. But I think, that all said, the secret to success in this industry is always right-sizing your balance sheet relative to your underwriting opportunity. So, industry growth is a nice to have, but it's not necessary for company success. But I think having that tailwind for our companies over the coming years can only be a good thing.
I'd certainly agree with that, Nick. Thank you very much for your time today.
Been an absolute pleasure. Thanks very much, Joss.
If you'd like to find out more about the Polar Capital Global Insurance Fund, please visit chelseafs.co.uk. Thank you.